Hey, what's going on, guys? So pretty interesting topic this week. I'm going to talk about how we leverage credit cards and use them for business expenses. So when we take out credit cards, first thing is we take out business credit cards specifically. So business credit cards, right? And then what we use these for, so we have various projects going on. We have wholesale deals, we have rehabs, we have new construction. So we mainly use it for our materials. So when we go to Home Depot and we spend $10K on materials, we use these credit cards, right? It helps us stretch out our money. So the first thing, we want to take out business credit cards because these credit cards, they don't report to the credit bureaus. So personal credit cards, they report to the credit bureaus, and then in turn, there's a bunch of factors that they take into consideration. And so they report back and they give you your credit score. By taking out these business cards, those don't report, so it's not going to affect your personal credit score, right? So say you have a high balance on a lot of cards that are business cards, your credit score is going to remain the same. So if you need to take out a loan, you're going to buy a car, house, if you need some money from the bank, they're not going to deny you based off of these because it's not going to be in your score, right? They're going to go off whatever your personal score is. So the first thing with business credit cards that we like to do, we like to look for 0% interest cards. So 0% interest, almost misspelled interest right there. So the reason we do this, right, we like to keep a balance on our cards. We don't keep a super high balance, we keep a decent balance. And so what this does is it stretches out our money, right? If we had a regular card, like a regular card with regular interest rates, then if we kept a high balance, then you would have to pay interest on it, right? So we don't like to pay interest, obviously, because credit card interest is very high. So we look for these cards. Now you might say, oh, there's not that many zero interest cards. Well, we have a ton of companies. We have about 10 companies in-house, right? And one of them's for wholesale, one of them's for flips, one of them's for property management. We have various companies. So all these companies, we could get the same card on all of them, right? Because they're different companies, right? We use them for similar expenses, but different companies. So we're able to get a bunch of these types of cards, and we're able to stretch your money out. The second thing we do is we keep a balance on these cards. We keep a balance and pay minimum. We don't always do this, but when we're short on money, almost forgot to spell minimum. When we're short on money, we want to stretch ourselves out, right? Because we want to buy time. So when we're doing our projects, these are going to take 3 to 4 months for a flip. It's going to take 4 to 6 months for new construction. So you want to stretch out the time that we have from we spend on materials to the sale of the house or the duplex or whatever we're working on, right? So those 3 months that we're building it, we're not paying. We're basically playing with free money, right? We're leveraging these cards we're using them as loans basically to pay for the house. So what we do is we pay the minimum, right? We stretch it out. Once the house sells, then we regain all our money. We pay our cards back, and we're good, right? And then we repeat the cycle. So that's very important. That's just buying you time, giving you free money to use on these deals. You might say, oh, well, what if the house doesn't sell? Well, I mean, that's also part of our business plan is we're looking for areas, we're buying low and we're selling high in areas that are proven to work, right? There's always risk in any business, but I like my chances with my team and the numbers that we're running on each deal. We're confident that it's going to sell on time. And we're also giving ourselves a cushion, right? It's not like we're just maxing out our cards, right? We're using them smart. You have to be smart when you do this. The third thing that I want to talk about is the Plum Card. So Amex, they have a card. It's a Plum Card. It's this card right here. Let's get out of the way so you guys can see it. But it's a Plum Card, basically an overview of it, and I included it in the newsletter for this week. So it has a brief description on it. It has a link to it. But it's basically you get a free 60-day loan, right? So you don't have to pay your full balance for 60 days. That's basically it's free money for 60 days as long as you pay. I think it's like 10%. Of your full balance by the 30th day. This is like gold. This is better than the black card from Amex, in my opinion. I mean, I don't have the black card, but I know what the black card benefits are. I know what these cards' benefits are, and this one's better for business because, again, you're buying yourself time, right? So if you're short on cash, you need to spend $20,000 for materials. Just throw it on the card, right? And once the house sells, you'll be able to repay it back as long as you keep paying back that 10%, right, of the balance. So this is a great card to get, and I'll throw the link on to get this card on the notes. So just really, I really recommend it, honestly. Like if you have a business, get this card. You know, it's relatively, like it has I forget what the annual fee is, but it'll pay itself off if you're smart with your business, right? So that's kind of all I wanted to go over today is, you know, how to leverage credit. People are scared of credit. We use it just how we use bank loans, right? We use it smart, and, you know, we make sure the numbers make sense before we apply for these cards and before we use them. So, you know, learn about it, learn about the credit game, because it could help you or it could hurt you. So that, I mean, that's on you. So we'll see you guys next time.